Brilliant. Let's see. Good afternoon, everyone. It's fantastic to see so many familiar faces joining us again. We've got some what we call super users here, just making sure everybody can get in. So this is the, third webinar in our Raising Equity Capital webinar series, and I am absolutely delighted to be joined by Sean Hackman, who's Director of Specialist Accounting Solutions. He's going to be running through business valuation today, so it's a massive subject to cover in the time that we've got allocated, but Sean's got a presentation that should take about 25 minutes, 30 minutes. And then we'll cover questions. So if you want to start putting your questions in the chat at any point so you don't forget them, that's great. But similarly, once Sean's finished presenting, it could be that I just say, you know, do you want to unmute yourself and ask Sean your question directly? Okay, so Sean, at this point, I must mention as well that just for the purposes of the presentation, I'm going to record it because we've got a couple of clients who can't make it, but I will not be recording the Q&A session because that's kind of together as a group. Okay, so Sean, at this point I'll pass over to you and thank you again.
Welcome. Hi everybody. My name's Sean Hackman. I'm the founder and director of Specialist Accounting Solutions, and welcome to this webinar. I'm going to share my screen now, so I'll run through the presentation. It'll probably take about 20-25 minutes, something like that, and then obviously we'll have some time for some questions after that. So just bear with me whilst I share my screen with you. You see this?
Yeah, that's perfect, Sean.
Brilliant. Okay, cool. So let's just test out that the page switch. Yeah, that's perfect. All right. All right. So welcome to this webinar today. So it's obviously titled "How Business is Valued for Investment or Sale." So my name's Sean Hackman. Very briefly, we're an accounting firm. Specialist Accounting Solutions is an accounting firm. We're based in Reading. We do advisory, financial outsourcing, and compliance. These are the kind of services that we provide. And that's all I want to say about that right now. So what's on the agenda today? So I'll be taking you through various valuation methods. First, we'll sort of go into the market approach using our earnings multiple formula, A times B equals C, and we'll run through the A and the B and the C individually. Then we'll look at the income approach, looking at discounted cash flows. And then after that, there'll be a section on valuing startups and what the challenges are and various financial metrics and other items that investors look at when it comes to startups. So if we start off with the market approach. So the market approach, well, actually, let's put something into context. Why would you want to value a business in the first place? Actually, there's a multiple of reasons why you would want to value a business. And you could be retiring. You might want to sell your shares. You could be seeking investment. You might want to say, well, actually, I can't stand my business partner. I want to get rid of them, or I'm getting divorced. So there could be good, bad, and ugly reasons why this happens. You might want to have an EMI scheme. You need a valuation for that. So there could be all kinds of reasons why you want to have a business valuation. So in terms of the market approach, what is the underlying methodology? So most SMEs, most of them, not all of them, but most of them can be valued using this methodology. So it's relatively straightforward formulas. A times B equals C, and we're going to run through the A, the B, and the C on the following slide. So in this example, our A are the underlying earnings. B is our earnings multiple, and we need to research and find that using sort of desktop research. And then C is the enterprise value of the business. So in our example here, we've got 100 grand or the underlying annual earnings of the business. Our multiple is 5, and our enterprise value on that basis is 500,000. So that's the value of the business. So how do we actually find A, and what is A anyway? A is what we typically use is the earnings before interest, tax, depreciation, and amortization. And in other words, that's also known as EBITDA. So finance community is very focused around EBITDA. Why is that actually? What's the reason behind that? Is one of the key reasons for it is because it's the best proxy for cash and therefore profitability. So it's a number that you can calculate, and it's usually quite similar to what the business can generate in terms of cash. It's also unaffected by how the business is financed. So what I mean by that is you could have one business that has a huge loan, but actually, for argument's sake, does exactly the same as company A. Company A doesn't have a loan, and company B does have a loan, but company A is heavily debt funded. And the key thing is here that it's the earnings before interest and tax. So before interest, in other words, you ignore the interest payments, and therefore it sort of it compensates for any differences in the capital structure, is probably what I'm trying to explain to you. So it gives you a level of underlying profitability of the business. We do make various adjustments to work out an average or a weighted average EBITDA when we calculate this EBITDA, because really what we want to do is we want to find the average maintainable earnings of a business. So quite often when we look at established businesses, we look at the last 3 years, including the current year, and we work out on a maintainable earning. So those are sort of the main reasons why we do that. So if we have a look at these adjustments, well, what are they? Well, typically we look at exceptional items or non-recurring costs. So say, for instance, you're running a business and you've got a legal dispute with one of your customers or one of your staff, and you've got to spend a load of money on legal fees. You know, you might want, we're going to be adding that back because it's not part of the operational side of the business. It's something that just happened and you had some additional costs one year. We could be doing that, so that comes in both forms, both in form of cost, but also in terms of income. So for example, one year you might be selling a load of assets, you might be making a huge amount of profit, or you could be getting some grants, for instance. So we deduct that exceptional income as well. Then the other thing that we usually do is we add back non-cash items, because normally our starting point is the operating profit. And so we add back depreciation and amortization. And then the other thing that we do, which is sort of how should we say, a characteristic of most businesses in the UK that are run by owner managers, that we add back the directors' salaries, because they typically reward themselves or take the remuneration in terms of a very low salary, say for example just 12k, something like that, and the rest they take in dividends. And obviously you don't see that in the profit and loss account. So we tend to show the full earnings as a market rate salary and adjust for that, so we can actually really see well what's the true earnings, because as you know, dividends don't go through the P&L, at least not on the face of it, from what you can see on the accounts. So that's quite an important point to make. So how do we, that's our A. Obviously, in terms of the, just going to the A, we make those adjustments, and then as I said, we do a weighted average over the last 3 years. Typically we apply more weighting to the current year. So the current year is usually weighted, you know, usually has over 60% weighting in terms of you know, the last few years, because we want to know the emphasis of you know, the emphasis of the valuation should be on the most recent performance, and the way you do that is by providing more weighting on the most recent year or the current year in which we're currently in. So in terms of the B, how do we actually find the market multiple? Well, typically we're looking at transactions in the same sector over the last 3 to 5 years, and what we tend to do is we as a firm, we use a database called Market IQ from Experian. It's very, very good. It's got lots and lots or many thousands of transactions in, so not all multiples are disclosed. So in other words, you'll have a transaction in where, you know, company A buys company B, but you know, there's no multiples shown. And by multiple, obviously, I mean this figure here, this number here, that, so for example, that 7.31, the 9.04, etc. So we're looking for an EBITDA multiple. So it's a multiplication of the EBITDA figure that ultimately gives us the enterprise value. And what we tend to do is we do a lot of research. We scour the database for transactions. We also look at listed companies, because obviously they tend to be very acquisitive. Some of them, you know, have a specific strategy to hoover up smaller companies and effectively undertake a buy and build scenario. And so we use an awful lot of information that's out there, but a lot of it's actually in the public domain, and you'd be incredibly surprised how much information is actually available in the public domain that we don't necessarily have to pay for to obtain. It's just more about having the time and the nous to find it, and the knack to find these things, because obviously the notes in staff accounts can be very, very detailed. The other thing that we tend to do, and it depends on the kind of assignment that we have, but we also use earnings multiples of companies in the same sector. So that's known as the market comparable method. So they're listed on the stock exchange, and obviously those multiples of those kind of transactions, they'd be a lot higher than you'd expect for an SME. So they'd be trading typically at sort of the mid-teens at least, usually quite high multiples. They then have to be discounted, as it were, or lowered to show a more realistic multiple of what you'd expect for an SME or a startup. So we tend to use those multiples as a benchmark, but we then take them down just for the sake of lack of liquidity, and obviously the fact that it's much easier to trade in those kind of shares as it would be in a SME share, which is not on an open market. So that's our B. And I think at this point, actually, it's quite useful to know what our C is. So C is our enterprise value. So A times B equals C, obviously. But actually, what is the enterprise value? What does it actually represent? What does it actually mean? And I tend to find it's usually quite helpful to bring in sort of the house analogy, because obviously most people want to buy a house in the UK's, and what we tend to find is if you compare the value of your business, the enterprise value, with the value of your house, and let's just assume those are one and the same thing. So the enterprise value in this example is 500,000, so that would be the value of your house. And then you've got your debt against it, so your net debt, which is 200,000, which means the equity value of your shares or the house that you own, for example, is 300,000. So in this example, we've got a house that's worth 500,000. We've got a mortgage of 200K against it, and the value to you as the homeowner is 300,000. Well, it's the same thing with the business, right? If you've got a business and you've got a say £1 million business, or in this case a 500K a business worth 500K, and you've got some kind of commercial loan in, some kind of term loan, and that's 200 grand, then the equity of your shares is worth 300,000. So if someone comes along and buys your business and says, right, I want to buy this business cash and debt free, in other words, free of any debt, ultimately they will pay 500,000 for it, but you'll only see 300, because the remaining 200 will be going to the debt provider, whoever that is, to the bank. So that's the difference between enterprise value and equity value, which is an important distinction. There's another thing that's, I think, is worth pointing out, that sort of terminology that gets used a lot, which is this pre and post money valuation. So what does that actually mean? So pre-money is the money is the value of the business that it's worth before any investment. So in other words, what is it worth now before I get any new investment in? And post money is effectively the value of the business after you've received that investment. So again, taking a relatively straightforward example, say for example, I'd start up a business today and I've got 600 grand's worth of cash. I put that in as share capital. I own 100% of the equity. Then I go to a number of angel investors and I say, listen, I've got this great plan. Do you want to give me some money, and I'll expand the business with your support and your cash? And they say, yeah, that's fine. We'll give you 400 grand. And in return, as you can see in this example, they now own 40% of the business. I'm left with 60%, and the value of the business is 1 million quid. So in this example, we had a pre-money valuation of 600,000 and post-money of $1 million. So that's broadly, in a sense, that's kind of how it works, just as an illustrative example. So moving on to the income approach. So we just had a bit of a detour into sort of some terminology and our market approach, sort of explaining that. Moving on to the income approach. So the income approach is very heavily focused around discounted cash flows. So the discounted cash flow is based on the theory that the value of an asset is equal to all future cash flows derived from that asset. So in effect, what you're trying to answer with the DCF, with the discounted cash flows, what are these amounts worth, or what would I pay for them now in one lump sum? So all you're trying to do is translate all the income streams that this business will generate going forward into a present value. And for that, you obviously need to know, A, how much you're going to be, generating. You need to have a forecast saying, well, we're going to be earning, 300 grand in year one, 500 grand in year two, et cetera, et cetera. And then also the other thing you need is you need to have a discount rate. And the discount rate is really all it is an inverse interest rate. So interest rates, say I've got £100,000 now, I get an interest rate of 10%. I know that 100 grand, oops, my lights have gone off, bear with me for a second. This happens because there's no one else in the office. There we go. I can guarantee you those lights will go off again during the course of this presentation. So you can laugh at me as much as you want. I warned Andrea about this, actually. I said this was going to happen, didn't I?
You did, absolutely. I was prepared.
You were prepared. So where were we? So discount rate. So discount rates, so we've got 100 grand now, we're getting interest rate of 10%, that 100 grand is worth 110 grand in year one. same thing with a discount rate. It's just the same thing in reverse. Say you've got 110 grand in year one, and you want to know what it's worth now. Well, using a discount rate of 10%, that 110 grand that's worth in year one is now worth 100 grand. So all you're doing is taking all that, you're going back in time. You're basically saying what is it worth right now from the future. So you're discounting it back. So what discount rates reflect the relative risk of investment as well as the time value of money. Well, what does that mean in sort of layman's terms? Well, really what it means is the higher the risk of investment, the higher the discount rate. So in other words, if you would be using, say, a very low digit discount rate for, a startup, and someone would say to me, well, we've used a discount rate of 3%, and we've got this great business plan, we've done this startup, and it's like, yeah, 3% discount rate. And I'm thinking, well, that's just not realistic. You need to have at least a discount rate of, I'd say, minimum 15% on any kind of startup business plan to make that realistic and reflect the risk that's around there. In particular, because arguably inflation is double digits at the moment anyway, although it's forecast to come down, to be fair. But I definitely see quite high levels of discount rates applies to startups, and I think if you'll be doing that and you're sort of looking into that, I think that's one tip from me. I think you should definitely look into that. The other thing that's important, and this is just going a little bit into the theory, and I didn't want to make this too theoretical, but just to explain where does the discount rate actually come from. It's usually calculated using a weighted average cost of capital. That's known as WACC. And that's basically the overall return rates for the total capital invested. So both equity and interest bearing debt. So what you do is you basically calculate, well, what return do my equity investors require? And that you've got a rate on that. What return do my, do the debt funders require? You've got a rate on that. And then you need to have obviously the approximate capital structure of the business, and then you calculate your weighted average cost of capital on that. The other thing that's really, really important when preparing a DCF, a discounted cash flow, is you do need a really robust set of forecasts. So you need to spend some time and effort on that to make sure you've got a set of forecasts that have got solid assumptions, or at least sort of reliable, a good understanding of how you've put it together and why you've put it together the way you've put it together. That's really, really important. Not to mention that it should be mechanically working properly, which is quite important. Obviously you can get software these days, but arguably, actually, and to be fair, most companies that I see that prepare forecasts, most of them still use Excel. We still use Excel very extensively, and in fact, it's probably one of the few programs that hasn't really been that much superseded by various SaaS offerings and accounting offerings and sort of forecasting software that you can see out there. The other thing that you need when you're doing a discounted cash flow is sort of the forecast period is very important. So quite often we see sort of that there's two kind of components to a forecast. So there's the forecast period, sort of the one that's sort of very explicit, which is the years 1 to 5. So normally we see first 5 years sort of shown, each individual year shown separately with lots of numbers in each row or column, whatever you want to call it. But then also there's the terminal value, and what's quite important to know about the terminal value is that the terminal value in a discounted cash flow tends to actually make up the largest amount of the sum that you're calculating. So say, for example, I've got a business that's worth, say, 100 grand, and I've calculated that figure using a DCF with a sort of first a 5-year forecast period and then a terminal value attached to that, or following on from that. Then usually you'll find that the total value that you calculate in the DCF, that 100 grand, typically, 70-80% can be just based on that terminal value. So it's very sensitive to tweaking, in particular on the terminal growth rate. So you'll have a growth rate where you'll say this business will grow at a annual percentage year on year into perpetuity. So basically all it is one lump sum where you say all the future revenues that I'll get from this business for forever will be based on that growth rate. So obviously that terminal growth rate is very, very important. If you make it too high, you get a huge number. And obviously it'll completely crowd out the first 5 years anyway, but it's very important to get it right, I suppose, is the answer, or spend a lot of time on trying to figure out how to get the most reliable answer. That's quite important. I just wanted to put into context, so what does all this mean? You know, how does all this fit into valuation reports that we kind of do? So we combine these different methods and trying to conclude on a value once we've looked at sort of the market method and the income approach. Now, obviously there's a net asset approach or there's an asset-based approach, but typically that tends to be with property heavy businesses or asset heavy businesses. Sometimes you see asset-based valuations in insolvency scenarios, or when an administrator comes in or an insolvency practitioner and sort of, you know, basically wants to sell off those assets. So it's popular in those scenarios and in property scenarios. We don't tend to use it. Typically, what you find is that you know, balance sheet valuation doesn't really reflect the true value of the business. Could be because, you know, the UK is very service heavy industry in general, a country, you know, where we sell more services than we make stuff, as it were. But typically, you know, we tend to use we don't tend to use an asset approach, so that's why I've not included that in my slides here. Just going back to the report, so we conclude on a value, we present that full report to a client, and we obviously got you know, research underpinning that with transactions and conclusions, as it were. Moving on to the next slide. So now, in terms of valuing startups, so a little bit of sort of extra detour into this area, which is obviously of interest to you guys. So we've got what are the challenges when you're valuing a startup? So I mean, it is obvious, but not necessarily so. But most startups don't have any revenue, or they've got minimal revenue, or they're you know, they've made a little bit of money, but nothing of note. And also another very common characteristic is there are no profits. They're making losses. They spent all their money, and all they're doing at the moment is just incurring costs and trying to get this product or service off the ground. The other challenge that we have is, you know, there's no sort of contracts or customers. The business model might be entirely unproven. You know, we simply don't know whether this thing will work, or if it has worked, to what extent will it work in the future. It could be that just it's a very, very nascent business. So that's a challenge in and of itself. So in the face of that, how do investors kind of tend to go about this? Well, so in the early stages of investment, so the management team is probably one of the most important considerations for the investors. So they will look at the management team, and they will want to assess the management team ultimately. And they want to say, well, you know, on what basis should we invest in these guys and their idea? The first thing they would probably be looking at is going a little bit further back in history. You know, what kind of subjects has the management team studied? What academic background and accolades have they got? The second thing to note is the work background. So has the management team worked at well-known corporates or consulting firms? Have they entered industries that are actually hard to enter? What's their track record? What have they actually achieved whilst they were in, let's call it normal, in inverted commas, employment? Does the management team have specific sector experience? Is there any evidence that they've got particular insights where they've spotted early trends or micro trends that they're picking up on, that they're building their business plan on? Have they got any evidence of doing anything notable in their work life in terms of you know, sector experience? Have they achieved anything in particular in there? So these things are really, really important. And obviously, you know, ideally you obviously want them to be having experience in the sector that they're pitching their business for, as it were, not something who's been, you know, in one sector and then kind of goes into a completely different sector with no experience. Maybe there are some transferable skills, you never know. The other thing that's really important, and this comes basically down to the business plan and also to, you know, what they've done so far, is you know, can the management team actually clearly communicate what they want to achieve? Is there any you know, how good is that presentation that they are showing us? Does it show us, you know, what they want to achieve? How much money will it cost? What are the exit strategies that they are proposing? You know, and over what time frame do they want to achieve that? And crucially, you know, that business plan may have been devised, say, a year ago or 6 months ago. So what's the track record against that business plan? Have they actually delivered against that plan so far? And how robust is it? What can we as an investor use as a proxy to say, well, you know, the business model that's been put in front of us, to what extent has that been proven by other competitors or other similar outfits in the market? To what extent does it exist at the moment in another country, in a slightly different form, and how can we sort of gauge, you know, the validity of this business plan? So as I said early on, I think it's more about the management team rather than the financial metrics. But that then changes, because obviously that turns into, you know, patience will run out eventually. You're going to have to start making money, and I think this is where it's probably important to sort of realize that these certain financial metrics are sort of more sought after than others. One thing that we've seen time and time again with startup businesses and how they get valued typically is revenue multiples. So startups that grow sort of 30 to 40% per year might be given a valuation of 6 to 10 times annual revenue. And that can vary a lot. Obviously, a revenue figure can be quite big in and of itself if you're looking to grow quite substantially, but they tend to be, generally speaking, revenue multiples tend to be used when it comes to startup businesses, because let's face it, you don't have a profit to go on, you don't have any kind of profitability multiples that you can apply, and obviously assets aren't really an issue. In conjunction with that, what's also really important for many, in particular in the tech sectors, is this monthly recurring revenue. So all that really tells you is, how sticky is your customer base. It also obviously implies what kind of business model you have. Typically, obviously, that'll be a subscription-based model. But the MMR or the ARR, the annual recurring revenue, that is just simply evidence of sticky customer base and client retention. And obviously, most startups are looking to grow that. In conjunction with that, obviously, you're looking at the growth rate. So that's the speed at which the company can grow. Typically, it's revenue, but obviously underpinning of all of that is, how many new contracts can you sign? How quickly can you grow your customer base? In how many new locations can you expand your, your coffee chain or your delivery service or whatever you want to be trying to achieve? Then in conjunction with that, in terms of, say, your B2C business, quite often this is used, your customer acquisition cost. How much does it cost to acquire a new customer? How many pounds do I need to spend every month on each new customer, and how much does each new customer cost me? And also in conjunction with that, what is the lifetime value of a new customer? How long will they stay with us? Typically, what do we estimate? And what are they actually going to spend over their lifetime with us? That's kind of really important. And sort of in line with that, obviously, you've got these retention ratios that are quite important. How often does a new customer use our service per month, per year? When is the next time that person will buy the product or the service? The other thing that we see, that's important are margins. Obviously, there's not many margins if you go down the profit and loss account that you can use. And the one that we see quite often at this stage is the gross profit margin. So that it is dependent on sector, to be fair. But a lot of assessments are made on the gross margin. Can you actually achieve that? Never mind what happens, below the overheads, because we know you're spending a load of money on them. General comments. I think it's worthwhile sort of going into sort of zooming out a little bit, just to give you sort of a broad brush picture of where we're at. So the level of return is typically higher earlier on. So early stage investors might be looking for a 10 times return on their money, because obviously they're coming in early, they're taking much more of a bigger punt. The business is not proven at this point in time. Later stage investors might be just looking for a 3 to 5 times return. So bear in mind, at that time, the business is probably largely much more proven and has probably got profits to back it up as well. The other thing that investors tend to do is they can work backwards. So they say, well, what is this business worth in when our investment wants to exit? So say, for example, we want to exit in, say, 5 to 10 years time. And what's it going to be worth on exit? Are we going to sell on a 10 times EBITDA multiple or a 10 times revenue multiple? The investor will then take their cost of capital, so they use their WACC, and they say, well, what's that figure worth right now? So they'll take their exit value, discount that back to the present value, and then on that basis they'll make an assessment of whether what their current what offer they should be putting in for the business, in terms of how much shares they want to apply for. And then the other thing is also to bear in mind is the size of the current investment round. Does it actually work? In terms of the sums invested, is the round actually big enough for me to deploy enough cash to get the equity that I want to receive as an investor? This is a model that we've not used in our practice ourselves, but we've seen other businesses valued on that basis. So if you're, for example, very R&D focused and IP focused, and you're looking to raise some capital, and I'm just quoting Investopedia here, but it could be a stage of development. So say, for example, you're very R&D focused, you're developing a plan, you've got an idea, the value of the business will obviously increase. Oh, lights have gone off again, bear with me. The value of your business will vary depending on the on the development of your plan. What have you achieved so far? Have you got a or a prototype, not to mention, you know, a management team that wants to do something? Have you actually started working on something? Have you actually produced something that is of note? And is there some IP here that we could potentially sell or license possibly, and also probably importantly protect? So remember, a good IP lawyer is worth his weight in gold, or her weight in gold. You know, are there, I think, sort of moving down here, you know, strategic alliances? Have you got any MOUs? You know, that's when you expect to sign some MOUs with some important partners. You know, typically you'll see those kind of businesses, you know, usually very small, where they're developing very niche type of IPs, but they will then be doing, say, for example, have an MOU with, say, a multi-billion-dollar company that will then sort of possibly partner with them on a certain project, or they'll be providing a certain service to them. So that's what you see quite often. Then I think, you know, once you start selling stuff, you actually start making a bit of money, and by money I mean making revenues, not necessarily generating profit, then you'll see your value obviously going up. But it really depends on the stage of development. But again, this is another useful framework, shall we say, for you to work with. And I think the key thing around that is to have an idea of you know, do your research. If you're sort of in this kind of area, try and find news or information, you know, around, you know, the areas that you're interested in, to understand the levels of valuation that are going here. I thought everything that I've got here, that I've talked about, sort of into a bit of context now, because obviously it's easy talking about all this stuff in theory, but what's quite useful is actually to see some numbers, and this is from book. It's quite a well-known sort of provider of data, and they produced this annual European VC valuation report. And obviously we know now what pre-money valuation means and what that is, yeah. And as you can see here, this is the pre-money valuation by stage in UK and Ireland in millions of euros. Obviously people have been pounds, but I didn't attempt to do a sort of translation of those figures into pounds, because I don't know what I've just left it as it was, just to use their data unredacted. But here we can see that, you know, these figures at an angel and seed stage, you're looking at pre-money valuation of somewhere between, you know, 2.3 and 3.2 over the last few years. I'm actually, let me just move this a little bit out there. I'll just move myself out of the way there, because I can't see this data. So you can see it's sort of between 3 and 3.2 over the last few years. I don't know why it sort of jumped up here. I really don't know, and I didn't go into the detail of the report why that has happened. But to give you an idea, you know, what are roughly the value of businesses that are sort of at this stage that are actually being transactions done, albeit, bear in mind, this is reported stuff. So, you know, there might be deals out there that no one's ever heard of because they're not in the public domain. So somewhere this information must be, you know, you know, obtained and analyzed, as it were. But it's quite interesting. You can see the sort of the pre-money value at 2.3, 3.2, early VC stage between 4.6 and 5.3 here. Again, it's sort of up a little bit, and then late VC stage sort of somewhere here between 6.8 and 11. So just to give you a feel, and I think seeing things in context in this kind of in evaluation scenarios is very, very important. And then moving on to the median deal value. So median is just a slightly more solid approach, trying to work out an average. It sort of skews out these sort of the outliers that are either really, really small transactions or really, really big transactions. So again, median deal value by stage in UK and Ireland in millions of euros. So here, look, you can see, look, what does this, you know, how much is this angel investment worth around? You know, roughly about half a million to just under a million here, up to 1.2. Early VC stage, how much do these guys invest? Somewhere between 1.1 and 1.6 here we can see, and then late VC stage, sort of somewhere between 2.3 and 3.8. So again, putting stuff into context to give you some kind of feel, what are we actually looking at here? What does this actually mean? Just a sort of a third slide here, and this is from the States, so it's from the US market. So again, to give you an idea, well, how much a percentage share is actually being acquired in you know, at the angel, seed, early VC and late VC stage. So this is quite interesting, isn't it? So early angels sort of tend to invest sort of in high teens in terms of the equity that they're acquiring. Seed sort of high 20s really, and early VC stage low 20s, and then it goes high teens here. And interestingly enough, that kind of trend seems to be pretty much borne out on all other sectors, with the exception of fintech bit. So we've got enterprise tech, consumer tech, and fintech here. it's sort of, for some reason, it's down massively here. I don't know why that happened, but that is what it is. But again, it gives you just a rough feel of, you know, putting these numbers into context. So you've got roughly an idea, well, how much do I actually have to sell? What's actually going on here? Just to give you some feel of what's happening here. What homework should founders do, in my opinion? What should they do? What's the best way to sort of go about this if you're sort of asked, or you're operating in the sphere of you know, coming up with a valuation? Well, I think you should, you know, if you're in a position where you're looking for money and someone asks you a question, you know, how have you come up with that valuation? You need to be able to give them an answer, okay? And I think you need to spend some time on that. And so the first thing, we've talked about it before, I think you need a robust financial model. I think that's really important. But the other thing is you could sort of approach your valuations from various angles. So the first one will be a top down, and you say, well, you know, the market size is worth X billion of pounds, or millions of pounds. We're trying to get a market share of X over a number of years. And then what does that mean in terms of corresponding revenues and costs? So you could do it sort of top down. The other way you can do it is you obviously do bottom up. When we're probably familiar with that, we say, well, we're going to win X amount of contracts, or win X amount of customers, or expand in X amount of locations. Again, what does that look like in terms of revenues? What does that look like in terms of costs? And then the other thing that is probably overlooked in a lot of cases is do your own research. Try and find out, you know, what deals have been done with competitors in your market. Obviously, it's not always you won't always have all the data available, but you know, there are snippets of information. If you can piece all that together, it's usually quite good to give you a context. Of, you know, size of investment might be shown, frequency, have there been a lot of deals going on? You know, where is this reported? There might be certain websites that show this over and over again. So that would be my sort of my tips for founders, that if they do get put in the hot seat and someone says, well, how'd you come up with that figure? And you say, well, yeah, I've done this, and this, and at least you've got an answer. You can say, well, it's not just been plucked out of thin air, because quite often we find, you know, valuations, is people come up to us with a figure and they say, well, we think it's worth X, and then you say, well, how did you work that one out? Oh, well, because that's how much we need. It doesn't quite work like that. So that's where we are. So that's me done now. I don't know, shall I stop sharing my slides, Andrea, or should I just keep it like this? I'm quite relaxed.
If you stop sharing, that would be brilliant, and then we can see everybody's faces.
No worries.
Sean, that was amazing. That was and fantastic. You've included. Am I okay to circulate the slides afterwards, so they've got your contact details and so on?
Yeah, sure. I might do a slightly redacted version of the slides because it's RIP, but bear with me on that one.
Oh yeah, by all means, yeah, that's absolutely fine. That was fantastic. It's such a huge subject to cover in the time that you have, so well done. We've got some cracking questions. I'm just going to stop recording because I don't want anybody feel like